Hey everyone, welcome to Chapter Two's example. This is part one of the example. So in this video, we're going to be doing the journal entries and the T-tables. And in part two, the next video, we're going to be taking everything that we did in this video and putting it into a trial balance. So this is going to give you a couple steps in the accounting cycle, a little bit of practice. So let's go ahead and begin. In the problem, it says, Bravo Company provides consulting services to its customers. The company began the year with the following account balances. So we began the year with a cash balance of $20,000. That means we ended last year with $20,000. The ending of one year becomes the beginning of the following. We had a beginning balance of supplies of $400, a beginning balance of common stock of $10,000, and a beginning balance retained earnings of $10,400. So again, this implies that this is not the first year of the company. We actually do have beginning balances. So in order for us to begin this problem or get this problem started, we need to go ahead and get the T-table set up for those accounts. So there's the pages for our T-tables and our journal entry. Let's go ahead with the cash T-table. We need to create one, so it's just, again, cash with a T, capital T. Cash tends to be a little bit longer because we use it more often. It's exchanged more often. So you want to give yourself a little bit more room on this one. The size of your T-table may want to be a little bit bigger. But cash T-table is an asset T-table, so it follows the plus minus on the debits and credits. So our debit is plus, and remember, all of our balances should go on the normal side. The normal side of a T-table is the plus side. So for us, the beginning cash balance is going to go on the debit side, and so we'll put beginning balance of $20,000. Supplies is next, so I'm going to create a supplies T-table. And again, supplies is an asset, so again, I'm going to put the $400 balance on the debit side because that's the plus side or the normal side. So beginning $400. Common stock. Common stock is a type of equity account, and it follows the minus plus on the T-table. So I'm going to create my common stock T-table. And the balance of $10,000 is going to go on the credit side because, again, that is the plus side for common stock. And lastly, retained earnings follows the same thing. We'll create a retained earnings T-table and put it on the credit side of a balance of 10.4. Now, I know this looks really odd because I've spread all these accounts at different areas on the paper, but there's a reason behind it. This is just something I do. You don't necessarily have to do this. You can kind of go at it your own way. I just like to have mine kind of clean and set up. That makes organization a little bit easier for me to be able to see it. Everything on the far left is going to be my assets. So all my assets are going to go in this kind of yellow area. All of my liabilities will kind of go in the upper middle, which is the red area. We don't have any right now, but that's where they will go. And then all of my equities on the far right. That's kind of, again, my system. You don't have to follow it if it's not asked of you, but it's just an easy way to look back and say, hey, what is this? Where is it? Where's it going to go? And all that good stuff. So again, my method to my madness. All right, so let's get into the transactions now that we've done the T-tables. Now also, too, I want to point out, notice we didn't do any journal entries for the beginning balances because those have already been journalized last year. Beginning balances are not journalized for the next year because they're already on the books. So we didn't do any journal entries for those. So now let's get into the transactions. On 1/1, it says Bravo Company acquired an additional $30,000 cash by issuing common stock. That means somebody gave us money to invest in us in exchange for common stock that we gave back to them. So let's put this into a journal entry. Our date is 1/1, and we're going to follow the same strategy that we did in the last chapter where I asked myself the question, is cash involved? And in this situation, it is. Our cash is involved. We received $30,000 cash. And what is our cash doing? Well, in this situation, it's going up. So we're going to debit cash. So I will start with my cash as the debit for $30,000. And what is on the other side? What's it in exchange of or for? And that's going to be common stock. So we're going to credit common stock for $30,000. That is our first journal entry. But now that we've done our journal entry, we need to put it into our T-tables. Now we already have these T-tables, so we're just going to add them onto the already existing ones. So on the debit side, I'll put 1/1 of $30,000 for cash. And on the credit side of common stock, I will do the same thing. And that's transaction 1. So let's go to transaction 2. Bravo Company completed a consultation for a client for $165,000. An invoice was sent to the client, but not yet collected in cash. So in this one, we've done the work. We've sent the client the bill. They just haven't paid for it in cash yet. They still owe us. So again, first question, is cash involved? Well, no, cash is not involved here because they haven't paid it yet. So then we ask ourselves the question, what are we expected to do with that cash at a later date? Well, that cash we're expected to receive at a later date. So this makes it accounts receivable. We will go 210 as the date, and accounts receivable is an asset. So we're going to start with the debit of accounts receivable because we're making our asset go up, and for 165,000. And then what is the other side? What is the credit? Well, we've done the work. We've earned this value. So because we've earned it, we're going to put it into a revenue account, and we're going to call that just consulting revenue of 165,000 as a credit. So I don't have either one of these accounts as a T-table, so I need to create these T-tables. So I'll put AR, I'll put it again on the debit side for 165, and then consulting revenue, put it on the credit side again for 165. And that's transaction 2. Now, if you want to, and I would highly suggest this, if you want to pause the videos and go to the next one and try the next one on your own, and then come back and check it, and then the next one on your own, that's a great system just to kind of see what you do and what you don't know. So if you want to pause it here and go to the next one and then come back and check it, that's great. Please do that. I'm going to go ahead and go on now. 228. Bravo Company paid $20,000 cash to its employee for work done on the consulting contract. So 228 is our date. Is cash involved here? Yes, cash is involved. It says $20,000 cash. What is our cash doing? Our cash is now going down because we paid this to our employee. So our cash is going down, and in order to make cash go down, we need to put it as a credit. So let's go ahead and credit cash for $20,000. Now we need to know what the debit is going to be. Well, we've used our employees' services, and what we do, the things we use, we expense them. So this is going to be an expense account, and I'm just going to call it salaries expense because I'm paying for their salary for $20,000. So I need to, again, make another T-table for salaries expense. This time it's going to go on the debit side because it is an expense. Expenses are plus minus. It is going to be $20,000 as a debit for salaries expense, and then $20,000 as a credit for cash because, again, our cash is going down. All right, transaction 4. On 4/1, Bravo signed a 1-year lease and paid $24,000 upfront to rent office space. The 1-year lease began April 1. So in this one, we're paying for the use of something, but it's for the future use of something. We're just paying for it up front. We're prepaying for it, okay? So let's go through our steps. Is cash involved? Yes, cash is involved because we paid $24,000 cash. It doesn't say cash, but it also doesn't say on account, so we assume cash right now. Our cash is going down, so that means we're going to credit it. So I'll start with the date 4/1 and credit cash for $24,000. Now, the debit, it's not an expense because we haven't used it yet. What we're doing is we're paying for the right or the ownership to use it. And so therefore, this is going to be an asset, and it's pretty much exactly what it says. This is going to be called a prepaid rent. We prepaid for it up front, and it is specific to rent. A lot of times you'll see these with prepaid insurance or prepaid rent, the most common ones. I need to create a T-table for prepaid rent. Again, it is an asset, so it is plus minus. So I'll put it with the assets, put it on the debit side of $24,000, and then add the $24,000 to the credit side of cash. That is transaction 4. Now let's go on to the next one. On 4/15, Bravo Company collected $141,000 cash from its customers as a partial settlement for the consulting job completed on February 10th. All right, so we know, again, the date is 4/15. Is cash affected here? Yes, they're paying us, so our cash is going up, so we're going to debit cash for $141,000. And then what is the credit going to be? Well, they're paying us for what was an accounts receivable, so they're lowering their accounts receivable. So in order to lower it, we're going to credit it, so I'm going to credit accounts receivable for the same amount, 141. I need to put that on my T-tables, so I'm going to debit cash for 141 and credit AR for 141. All right, that's transaction 5. All right, let's go to 6. Bravo Company was paid $18,000 cash in advance from a client for consulting services to be completed over the next 12 months, beginning immediately. All right, so our date 6/2. Is cash being involved here or affected here? Yes, cash is being affected. What's happening to our cash? Our cash is going up because they're paying us in advance. So if you remember back on 4/1, we prepaid for something. In this one, they're prepaying us for something. So it's kind of on the other end. But our cash is going up, so we're going to start by crediting cash. we're going to start by debiting cash of 18,000. And then the credit, this is money that they're paying us for work to be done, but it hasn't been done yet. So we haven't earned it yet. We will when we do the work, but we haven't earned it yet. So what we're going to do is we're going to credit unearned revenue, which is liability. We still owe that service. So it is a liability. Unearned revenue for 18,000. And then I'm going to, again, make my T-tables. I'm going to add the 18,000 to the debit side of cash. And I'm going to create an unearned revenue T-table and put 18,000 on the credit side. All right, that is the 6th transaction. Let's go to the next one. All right, I got to move some paper up. 7-1. Bravo Company purchased $1,500 worth of supplies in cash. Again, is cash involved? Yes. Cash is being affected. How? It is going down because we purchased the supplies, so our cash is going to go down. So if cash goes down, our date 7-1 is going to go on the credit. So cash credit for 1,500. What is our debit going to be? Well, in exchange for the cash, we're getting supplies. That's going to be an asset, so we will increase our supplies by 1,500. Put these on our T-tables. 1,500 on the debit side of supplies, and then 1,500 on the credit side of cash. All right, on to 7-15. On 7-15, Bravo Company paid $44,000 of miscellaneous expenses on account. So 7-15 is our date. Is cash being involved? No, cash is not being involved because it says on account. So that lets me know that I'm putting it on my tab. So what am I expected to do with this cash at a later date? Well, I'm expected to pay cash at a later date for this. So this is going to be an accounts payable. Accounts payable is a liability. So we're going to, in order to increase liabilities, it needs to go on the credit side. So we're going to credit accounts payable for $44,000. And then on the other side, what are we going to debit? Well, this is an expense. It tells us an expense. It actually tells us the name. So we're just going to put miscellaneous expense for $44,000. I'm going to create a miscellaneous expense T-table for $44,000 on the debit side. And I'm also going to create an accounts payable T-table because I don't have one with $44,000 on the credit side. All right, that's that transaction. Let's go to 7-20. Bravo Company purchased some land worth $120,000 for $100,000 cash for future expansion. Now there's two numbers here, and it's here for a purpose because, again, we want to go back to our accounting principles. One of the accounting principles is the cost principle that says that we have to keep things recorded at cost, what it cost us. All right, so our date, let's go ahead and get into the journal entries. Our date is 7-20. Is cash involved? Yes, cash is involved. What's happening to our cash? It's going down because we purchased it, so we paid the cash. Cash goes down, but by how much? I care about the 100,000, not the 120. I don't care what it's worth. I care about what I actually paid for it in cash. That's the cost principle. So I'm going to keep it on my books for what it cost me in cash. So $100,000. And then on the debit side, what am I getting in return? I'm getting land. And that land, I'm going to put, again, keep it as $100,000. I want to make sure my debit and my credit equal in every single one of these. So that's what it looks like. I need to create a land T-table. So there's my land T-table with $100,000 debit. And then I also need to put $100,000 on the credit side for cash. All right, 8-15. Bravo Company paid $30,000 cash as a partial settlement for its accounts payable. All right, so 8-15, is cash involved? Yes, because we're paying off our accounts payable. Our cash is going down, therefore cash will be credited. And so we'll put credit cash of $30,000. And the other side of that is we're paying off our accounts payable. In order to get accounts payable decreased, it needs to go on the debit side. So we're going to debit accounts payable for the same amount, $30,000. Now we need to post into our T-tables, debit accounts payable for $30,000, and then credit cash for $30,000. All right, 12-1. Bravo Company paid $5,000 in cash dividends to its stockholders. So we've declared dividends, now we're paying them. Is cash being affected? Yes. What's happening to our cash? It's going down. I'm going to credit cash for $5,000. Again, 12-1. And then what's the other side to it? What's the debit? This is going to be dividends because, again, it tells us dividends. for 5,000. I need to create a dividends T-table. So dividends T-table, 5,000 on the debit side, and then I'm going to credit cash T-table for the same 5,000. And the last one, 1231. Bravo Company signed a contract for $187,000 in consulting services to be completed over the next 12 months, beginning January 1st of the next year. So we need to figure out what the journal entry is. Well, what is happening here? Essentially what this is saying is I'm promising to do work for 12 months, and the customer is promising to pay $187,000 for that work. But all of that happens next year. Remember, one of the parts of the accounting cycle is your ability to analyze when we need to actually journalize, when we need to record. And in this one, we're saying, I'm promising to do work and you're promising to pay cash, but all these promises are going to be done next year. Nothing is actually changing hands. Nothing is actually moving. It's just simply, if you want to think about this, it is simply a handshake that says, yeah, we'll do business later. And you don't recognize handshakes. So for that reason, it is going to be no entry. It's not applicable. So you would essentially leave this one blank. There would be no journal entry. If it's asking for a journal entry, then you would just put non-applicable or whatever the answer may be. But you can't journalize this because nothing's happening. Cash is not going up. AR is not going up or down. AP is not going up or down. AR implies that we have done work and somebody owes us money for that work. Well, we haven't done anything for this. AP implies that we owe money because we've already got something. We haven't got anything and we don't owe any money. There's no revenue because we haven't earned anything. So this is just a non-applicable. You can't journalize this. So this is one of the things with accounting is your ability to look at it and understand when you do and when you don't have to journalize. That's how we do the journal entries in the T-tables for this problem. In the next video, we will be taking all of this information and putting it into a trial balance. I hope this was understandable to you. I hope you enjoyed it. Y'all take care.